Hi and welcome to Swissquote's Daily Market Talk. It's 18th of June, the day after Kevin Warsh's first policy announcement as the new Fed chair that brought a few surprises and surprisingly not necessarily dovish ones on the table. So US yields are higher today despite falling oil prices, and equities look somehow concerned about the unexpected hawkish shift in the Fed's policy. So we will discuss about how the Fed looks under Kevin Warsh, what are the challenges for those who watch, and what it means for financial markets. But before we move forward, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So this week's FOMC meeting didn't really go according to the plan. As expected, the Fed kept the interest rates unchanged and the vote was unanimous. Price stability emerged as the winning force between the Fed's dual mandate of inflation and maximum employment. And because the US is grappling with inflation above 4% thanks to its government's decision to poke the Middle East, and because the latest US jobs figures look somehow improved, this month's verdict was clearer than the past meeting. The dot plot showed that 1. The Fed officials remain inclined to hike the interest rates this year, with 9 of them plotting at least one rate hike before this year ends, and 6 considering that 2 hikes or more would be appropriate. And 2, Kevin Warsh refused to add his dot on the dot plot. He doesn't like the concept of forward guidance. He doesn't think that making predictions helps, and he is putting together task forces to change the way the Federal Reserve communicates its strategy, manages its balance sheet, uses and relies on the data sources, and on productivity and jobs. Now, scaling back the number of Fed comments, I think, is a good thing because, yes, we all agree that there are too many of them speaking too much and there are too many comments flying in the air, and that's making too much noise. Scaling back the size of the Fed's balance sheet is a great idea as well, but every investor out there knows very well what would happen to the financial markets when that post-global financial crisis liquidity is pulled back, relying less on delayed and frequently revised government statistics and more on real-time market signals such as yields, credit spreads, commodity prices, and inflation expectations from TIPS, for example, private sector data, and productivity trends to better gauge where the economy is heading rather than where it has been is a great idea as well. But not willing to put a dot on that dot plot, however, is double-edged. Of course, today with the level of unpredictability of the US policies, it is impossible to make any predictions. At best, you build scenarios. But leaving the market without any forward guidance means that the Fed decisions in the future, in the Warsh era, will be less predictable by the markets and hence will come as a surprise, which will undoubtedly inject volatility in the financial markets. Because remember, the Fed decisions today are somewhat a formality. The Fed guides the markets and investors toward the decision, and in most cases, the decisions are mostly priced in. The market readjusts to details by making a few dovish or hawkish adjustments, but that's about it. Now, if you shush the Fed members and do away with the forward guidance, the Fed decisions will come as a surprise and the monetary policy transmission could be less effective. So I'm a bit skeptical on that last point. But all in all, the Warsh era looks set to be markedly different and potentially far more volatile than the past 2 decades. And I guess we will find out more as we move on regarding will it be better or will it be worse for the markets. For now, the Fed's hawkish policy announcement on inflation concerns sent the US 2-year yield that is known to best capture the Fed expectations to the highest levels in almost 1.5 years. The spread between the US 2 and 10-year yield fell to the lowest levels in a year. An inversion here could mean economic trouble with possible recession, mind you. And activity on Fed funds futures now assesses more than 70% chance for an October rate hike from the Fed and nearly 85% chance for a December rate hike. Naturally, the thought of hawkish Fed policy and higher interest rates ahead weigh heavily on risk appetite. The S&P 500 and Nasdaq 100 both sold off yesterday around 1% after the Fed decision, and the Magnificent 7 fell nearly 3%, leaving many open tabs in investors' minds and, of course, a sour taste in Dove's mouth. The thing is, the decision was so unexpectedly hawkish that one has to wonder whether it wasn't a carefully orchestrated move to demonstrate Kevin Warsh's independence from the White House and from Donald Trump. After all, everybody knows that Kevin Warsh was appointed by Donald Trump with one clear mission: to lower the interest rates. He has been called sock puppet for months, and truly, I was very positively surprised yesterday by the changes that Mr. Warsh is looking to bring to the Fed. Because I also think that the Fed policy got just too fat over years, that the Fed gained too much importance and weight in investment decisions, and that it would be very, very healthy to cut some of the fat off the balance sheet and let the fundamentals, like the company fundamentals, drive the market moves. The good old fundamentals like how much money a business makes and how much it spends and stuff like that. But on the other hand, I can't stop thinking that this man has still been appointed by Donald Trump, and it was just his first meeting. So time will tell what's going on, but in the FX markets, this hawkish Federal Reserve policy announcement yesterday pushed the US dollar higher against most majors, obviously. The euro dollar shortly slipped below the 115 mark, the dollar yen pushed higher above the 160 level, and cable tipped a toe below the 1.33 mark. Today, the Bank of England is expected to maintain its interest rates unchanged thanks to a relatively soft inflation data recently, suggesting that price pressures in the United Kingdom didn't necessarily rise further, or they didn't rise as much as feared. Maybe the high competition among the UK retailers helped tempering price pressures, or maybe people who already deal with a restrictive fiscal policy couldn't stomach higher prices. But the Bank of England knows that the time is ticking louder toward the revision of the energy price cap this July, which will make the inflation figures in the UK look a lot more different than they are today and a lot more in favor of a rate hike. The good news is that oil prices keep pulling lower this week into the scheduled signing of a peace deal between the US and Iran this Friday, and maybe it's Thursday, as said by Donald Trump. US crude is trading below the $75 per barrel level this morning at the time I'm talking here, despite Israel's refusal to end the war in Lebanon. But the bad news is that the latest European Central Bank and Fed decisions clearly show that policymakers in the US and in Europe do not necessarily rely on the idea that lower oil prices will immediately cool down the inflationary pressures. So for the markets, a combined monetary policy tightening from the major central banks and higher yields across the globe are not supportive of market valuations. And inside the markets, the big technology came out unbruised from the latest monetary policy tightening period thanks to the nascent AI and the ample free cash that these companies had in their hands to navigate through higher interest rates. But today, the big technology companies are taking on debt to finance their massive AI build-out. And that's making them much more vulnerable to rising borrowing costs than the latest tightening cycle. Well, as for now, investors seem little concerned by the rising borrowing costs at the current valuations, and amid the rising bubble concerns among big technology companies, some investors are preferring to rotate toward bond markets. This week, Nvidia successfully made the market absorb $25 billion worth of a bond issuance. That was higher than $20 billion they first considered. And more broadly, big technology has become one of the largest borrowers in corporate debt markets, issuing roughly $120 billion of bonds in 2025 and already more than $150 billion so far this year to fund AI build out. Is this a good thing? On one hand, the demand for the big technology bonds confirms that investors remain willing to finance the massive AI build out. But on the other hand, higher debt highlights the growing dependence of the sector on interest rates and future revenue growth to justify an increasingly debt-funded investment cycle. So my conclusion is the AI revenue had better grow fast to keep this kettle intact. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.